some of the questions. I think we should start right now so that we don't delay anyone. Just looking at the environment and looking at what we've been seeing, particularly in terms of government policies, and this environmental scan is really for the whole business, both in Zim and across the region. What we are seeing is that subsidies are continuing and input schemes are continuing. The countries where there are major input schemes, Zimbabwe, Malawi, Zambia, and Tanzania, and those we think will be continuing for the foreseeable future. We're also seeing quite a bit in terms of price controls, particularly in Malawi and Tanzania. We're seeing the governments trying to influence the price that the seed is sold at to try and seemingly protect the customers. Policy uncertainty remains an issue. I think we all know the challenges that we have in Zim in terms of changing policies, but we're also seeing this in other markets that we operate in. Supply chain disruption, a real issue, particularly when you look at what has happened to the inputs that farmers, hotspots that we are seeing, the Ukraine war, what's now happening in Iran, and commodities and so on. We also seeing emergence of middlemen in some of our markets where government. We're seeing middlemen coming in and brokering deals for supplies in government. The latest country joining that movement being Mozambique. Increasing exchange control surveillance, not just in Zim, but also in the other markets. As you will know, most Southern African countries have got challenges in terms of currency, and we are seeing more and more increased surveillance. Here in Zimbabwe, during the selling season, huge challenges in terms of what currency and what rate you are converting your US dollar effective price to in terms of local currency. And yeah, we had to contend with quite a number of interventions there. I think globally we all know what has been happening with the Trump 2 policies, the dismantling of US aid, and we know that quite a number of African countries depend on, are donor dependent. If you look at countries like Malawi and so on, without aid, it's a big, big challenge. On the climate side, climate change is having a very negative impact on agriculture. We are seeing crop yields being affected, particularly when you have incidences like El Nino, which we had last year. And even this year, where we had normal rainfall, the starting, or the normal time that it starts was actually quite different. We started having meaningful rains in January, and in fact we ended up having some excess rains in areas. But once the rainfall pattern changes, it also does affect the planting, because the farmers, when they see the rains coming late, they start deciding to change varieties, either where they were planning to plant long season varieties, they start looking at early maturing varieties, or start tilting to crops like sorghum and so on, which require less water. And of course, we know that droughts are affecting power generation. We know that even though we had some good rainfall this year, and some of the farmers' dams are fairly okay in terms of water volumes, the challenge then becomes power generation to support the irrigation. It's not just water, but you need power, and that is a direct result of Kariba having been at its lowest for a number of years. When you look at the markets, what are we seeing? Increasing informalization. Here in Zimbabwe, I think we know what has happened. The formal retail sector is fast losing ground. A lot of the trade is now happening in the small tuck shops and corner shops. And what that does is, in terms of seed to be changing our model. What we have actually seen is a number of the retailers have been struggling to pay their debts as a result. We all know the challenges that OK went through. And we've seen this with other wholesalers, and it is forcing us to change the way we distribute seed. We are having to open our own shops. We are having to have our own till points at the various outlets so that we can also have control in terms of cash. Regulation, generally the issue of fake seeds is a big, big problem in most markets. When customers are hard up for cash, they easily fall prey to purveyors of fake seed, people who just take grain and paint it green. And it becomes our challenge to make sure that our customers are adequately educated in terms of what good seed is. Economy, currency devaluations right across Southern Africa, all the currencies basically went southwards. We know issues of hyperinflation, so Ethiopia kind of exited hyperinflation, but Zim, Malawi, Ghana, they are still there or thereabouts. Interest rates, a big challenge, and tight liquidity, also a big, big challenge. We know what has happened with the big disintermediation of banks that we've noticed. People are keeping cash under their pillows. As a result, the banks don't have access to the cheap deposit money, then on lend to corporates, and that's creating some serious liquidity challenges in terms of when we go to the market to try and borrow. I think in a nutshell, that's the environment that we are facing as a business. Just looking at our R&D, we do have a strong pipeline of new products, despite the climate change that we've been talking about. And in fact, our research goals every year are designed with the aim of addressing particular climate change challenges. So you find that all the research programs are looking very much at coming up with drought-tolerant varieties, varieties that mature early, varieties that mature as quickly as possible. Once you receive a bit of rain, you are able to see your yield improve. We are seeing a lot of progress in terms of our research for crop rot and foulam-tolerant varieties. Maize streak virus and maize leader-on necrosis disease, which is a disease that is prevalent in East Africa. We have been working on a program there with our partners, LG, and varieties are in terms of that particular program. The other thing that we are doing with our research and development is continuing to globalize it so that we can come up with varieties that do well in unique environments outside of Zimbabwe. You will recall that most of our research assets were based in Zimbabwe, but we are now strengthening regional research assets as well, because it's not all materials that are bred in Zimbabwe that do well in these other markets. So we are strengthening our assets in East Africa, in Kitale, in the Highlands, and we're also establishing a new research station at rice and yellow maize research in West Africa to try and make sure that our product basket addresses the requirements of the whole market. As usual, this year we did release quite a number of varieties in Malawi, in Nigeria, and in Kenya, and our product basket remains broad enough to make sure we are able to meet the customer demands. We've also released some wheat varieties and some sunflower varieties in Nigeria and in Tanzania, because we see these markets becoming more and more important in terms of these products. Successfully had a packing line in Zimbabwe, and we are working on color sorters to try and address the speed to market. We've been spending a lot of time hand picking before we send seed to the market, and the color sorters that we are adding are going to shorten the cycle that it takes to send seed to the market. We've also added on to our processing facilities in Zambia. We built an additional warehouse because Zambia remains our regional production and processing hub. We have also been able to successfully partner with banks to fund growers. Where funding of growers was predominantly on our balance sheets, we're trying to move this as much as possible off balance sheet to make our growers directly get funding from the banks. challenges under production, yeah, climate change still remains a big challenge, but I think the diversity of the group, the number of production bases that we have, does then allow us to cover for shortfall areas by producing in other regions. Just looking at what happened in terms of sales, so for Zimbabwe, Sitco Limited, we saw that our sales actually went up by 91% in terms of maize volumes, and soybeans went up by 59%, wheat went up by 8%. Barley did come down. As you know, with barley, we only have one real customer there. Produced is for Delta. And then the other crops also went up by 19%. Maize remains our anchor product, and we have actually been doing quite a lot in terms of our open market penetration. We did open our own shops across the country to try and cut the time that it takes cash to get to our till points. We also opened another shop in Kwekwe over and above the ones that we had already opened. We started opening some container outlets across the country, as well as the whole issue of having our own till points in specific retail outlets where we can directly control the cash. We did see record exports. 33% of that volume was exports, again aimed at meeting shortfalls that were in the region because of the El Nino challenges that were faced by the various countries. When you look at, so those numbers that I gave you for Zim, for the region, we actually saw a 4% maize decline and a 33% soybean decline. Now, those particular countries, it was basically a stock issue. They didn't have adequate stocks. Their production was badly affected by the El Nino challenges that we had in the previous year. This is the reason why the exports from Zim increased significantly to these countries, but still we couldn't meet demand in those markets. So you can see that that for our main product, maize, volumes actually did come down by 4%. Just when you're generally looking at our markets and how we see our businesses, so the yellow businesses are more or less the growing, the mature businesses. So you see that Zambia is yellow. It's a mature market. We've been there for over 20 years, and we think it's a mature business. Tanzania continues to show growth. It's a market that we like because we are creating new market, and year in, year out, we are seeing volumes growing. Malawi is a mature market. Kenya is a growing market, and in fact, we are only still covering 15% of the local market there. We know that the big market is in the highlands, where our research are focusing on coming up with a product for those, for that particular environment. Botswana is a mature market, small market but mature. We see our volumes remaining more or less the same year in, year out. And then markets like Mozambique, Nigeria, DRC, and Ethiopia, if you look at the percentages that we are achieving there, this is where we see huge opportunity. Nigeria and Ethiopia are big population countries with a big need for maize. Of course, some challenges in terms of political stability and in terms of production bases, but this becomes our work for the next few years, trying to unlock the production bases and increase the volumes in those markets, because this is where we see significant growth coming for the group going forwards. We also see some significant growth coming through from the Lakes region. So countries like Burundi, Uganda, and Rwanda, we've seen our volumes going up, and we need to start looking at local production in those markets. Angola is another interesting market that we've been seeing growing slowly. I think the big challenge that we've been facing with Angola is remittability. Once you sell your seed there, how to get the money out of Angola has been proving a challenge. All right, and I think that's it in terms of operational review. I'll ask Tinei to come and quickly cover the financials, and then I'll come back and cover the outlook. Tinei.
Good afternoon, ladies and gentlemen. So I'll give you an update of the financial performance, starting with Citgo Zimbabwe, and then we'll also give you an overview of the regional business, which is the main business in the region, Citgo International. Here is just some disclaimers around the distortions in our comparative numbers as we move to USD reporting for the first time this year. So an overview of the income statement, in line with the volume growth that Morgan alluded to, 52% volume growth, that also translated into revenue growing to 71 million. I would like to highlight that the main contributors of that revenue growth is maize at 68%, as well as wheat, 15%. In that 71.2 million, we did record exports this year, just under 10,000 metric tons, contributing just under 13 million to that revenue. So 18% of that 71.2 million is real revenue coming from exports. We also saw significant inroads in terms of the contribution of the open market coming in at 23.5, 33% of revenue coming from the open market. So that's a combination of, if you combine exports and the open market, that's 36.2 million. So 51% of the revenue is coming from outside, as well as the open market channel, which is largely on cash terms. The government business contributing the balance. If you add the sum of the government business, which is USD denominated, as well as the export revenue and the open market business, at least 90% of our revenue is now denominated in USD. We also have a significant line in other income, where we have 3.4 million in royalties coming from the region. So if you add that to the 36 million, that's 40 million sort of hard currency income coming into Zim. Zim also received about 340,000 in dividend income from the regional operations, and we do have 2.7 million in exchange gains. Overheads increased by 16% to 26 million, and as costs added in USD terms, also in line and accounting for USD inflation as well in Zimbabwe. The associates, which comprise of Citgo International, Prime Citgo Zimbabwe, Qton, contributed 3.7 million to the income of the Zimbabwean business, which is almost a treble compared to prior year. I must say within Qton, it's largely exchange gains, but in international, it's in line with the growth in the business, 15% PAT growth. So that bottom line of 17.5 million is coming from volume growth, the contribution of other income, as well as investments in the region. Looking at the balance sheet overview, we believe we do have a strong balance sheet anchored by proper plant and equipment. We have close to 100 hectares of land in Mount Upton, and we're looking at developing that land as the city approaches that area. The balance sheet is also anchored by R&D assets, which are mainly domiciled in Zimbabwe, as well as the IP, which is also contributing to the royalties that I mentioned earlier. The PPE on the balance sheet increased by 5 million, 2.2 million of that being additions, 5.8 being revaluation gains, which more than offset the depreciation of 2.4 million, as well as 400,000 in disposals. In the additions of 2.2 million, almost 800,000 of that is investment in R&D assets here in Zimbabwe. Our carrying value of investments increased to almost 32 million on the back of increased profits from the JVs and associates. We did record a decline in inventory in line with the record sales this year. However, our receivables increased by 33% in line with the increase in sales, as well as delayed receipts from government. Subsequent to year end, I think we have received 10.3 million combined, but we are still owed significantly by government. We also received 12.7 million from the regional business units in terms of what we sold into the region, as well as the royalties that the region pays to Zimbabwe. On shareholders' funds, it increased by 25.5 million, and the increase is coming from the PAT of 17.5 million, revaluation gains, as well as other comprehensive income at 1.5 million. Our borrowings increased by 5 million to fund the working capital gap from the delayed receipts mainly from government. Moving on to the cash flow, 1.1 million negative operating cash flow generation, and this is mainly attributable to the working capital changes. If you see the big number there of minus 20.1 million in working capital, that's the reason that is giving us a net position of 1.1 million in negative from an operating cash flow perspective, and this is associated with the delayed receipts from government. The irony of it is our corporate income tax increase to 3.4 million compared to 1.53 million last year. We are still expected to pay corporate income tax even though we are owed by the same authorities. We are in negotiations with them to try and see if we can offset what we are owed with our tax obligations. Like I mentioned earlier, we did invest in PP CapEx 2.1 million. We also recorded a reduction in interest payments on our borrowings as we negotiated better terms with our bankers, and we also took a deliberate action early in the year to settle most of our local currency borrowings before we then went back to borrow for seasonal finance. I'll move on to the significant associate, which is Citgo International. Looking at the income statement, despite the reduction in volume of about 9% that Morgan talked about, our revenue went up 15% to 124.3 million, and this speaks to the resilience of the brand, the product mix that we had weighing heavily towards high margin products. And 90% of this revenue is coming from maize, and 4%, 3% coming from soybean and wheat. We recorded a notable improvement in gross margin to 50%, speaking to the better product mix that we had, despite the product shortages that we experienced during the year. Our overheads went up 11%. This is lower than the growth in revenue of 15%, and this is in line with business growth. We also, for the first time, had an operational business, a fully-fledged operational business in Ethiopia, contributing to that increase in OPEX. However, our operating profit came down from 15.9 prior year to 15.3 million this year, weighed down by a once-off transaction where our interests in the South African joint venture were diluted to 1%. We opted not to follow our rise in terms of the capital increase that happened in that joint venture, and the deemed disposal loss for us was 2.6 million. So this is once off. It's accounted for in the 4.2 million other loss line there. We did experience challenging trading conditions in Mozambique. In fact, we virtually did not trade. We even had an incident where one of our trucks was banned during the selling season, which coincided with the political disturbances after the elections in that country. We, however, recorded significant savings in finance costs, 2.2 million, finance cost of 3 million compared to 5.2 million last year. And this is arising from a deliberate strategy to move cash as soon as there's excess cash in our various markets to service our borrowings. Where there are challenges to move cash and we have cash, we have also taken a deliberate strategy to pay off all local currency facilities, and we did succeed in doing that in Zambia and Malawi, resulting in that savings in net finance cost of 2.2 million. So overall, the bottom line is 15% growth compared to prior year, closing at 5.7 million this year. Here, I thought I would just share with you the evolution of the business in the region. From a top-line perspective, in 2018, we did a revenue of 64 million, and we are now talking of 124 million, and that's a 9% compounded annual growth rate, if you look at it. From a core EBITDA perspective, we did peak at 19% in FY21 and experience a dip in the following year at 14%, but we are now seeing a positive trajectory, and we are now at 18%, and our target is to achieve a minimum EBITDA margin of 20%. On the bottom line, we would be aiming to achieve a PAT margin of at least 7%. Looking at the cash flow, so we did invest 11.8 million more this year in terms of our cash outflows compared to 7.3 million prior year. And this is because of strategic reasons as well as the growth that we're experiencing in the region. From an operating cash flow perspective, we experienced a reduction from 23.7 million prior year to 11.4 million this year. And this is mainly coming from our ramping up of production, coming from trying to recover from the El Nino. So we did invest a bit more in terms of trying to boost our inventory levels by paying some of our growers advances to be able to do the production. We also did import significantly seed out of Zim, and that also explains that working capital movement. But we also paid more in taxes, 6.7 million compared to 3.4 million. Speaking of the increased profitability in higher tax jurisdictions like your Tanzania, for example, as well as Malawi this year. Our capex increased to 7.4 million, and this is mainly in Tanzania as well as in Zambia. We are doing a factory construction project in Tanzania, and we did complete an additional warehouse to boost our storage in Zambia. We borrowed less this year, and this is in line with our drive to generate cash and apply it to servicing our borrowings and manage our gearing levels. Because of that, that's the reason why we achieved the interest saving of 2.2 million. We did experience a negative 1 million combined effect from day one, IS-29 effects out of Malawi, reporting as a hyperinflationary economy for the first time this year, as well as the FX impacts combined. Moving on to the balance sheet. The balance sheet, in terms of balance sheet size, it registered a growth of 9% to 156 million. Compared to 143 million prior year, with shareholder funds growing by 17% to 93.8 million this year. From a liquidity and solvency perspective, we are seeing significant improvements when you look at it from a current ratio perspective, the quick ratio, and even our gearing levels improving from a net debt to equity perspective, improving from 18% last year to 16% this year. Main contributors of this growth in the balance sheet is your 7.4 million in capex projects in Zambia and Tanzania. We also did some revaluations across the group to try and account for the currency devaluations in these markets, and that contributed 7 million to the balance sheet. Our inventory increased by 1 million, mainly from early deliveries of seed this year. And our receivables increased by 5 million to 50 million, mainly because of the grower advances, the investment in working capital that I spoke earlier about. And subsequent to year end, we have collected about 10.3 million. Our shareholders' funds increased by 13.7 million from the profitability of 5.7 million, as well as revaluation gains of 6.2 million. Borrowings and leases combined witnessed a reduction of 4.8 million to 32.3 million on the back of the strategy to manage our gearing levels and utilize our cash more efficiently. From this performance, we did declare a dividend of 2 times cover from the regional business, which translates to 2.8 million, and this is a significant improvement compared to 1.2 million that we paid last year. We are also paying or ending the dividend drought in Zimbabwe and paying out a dividend of 2.3 million this year. And we will be watching liquidity should we manage to collect earlier than we anticipate from government. We may consider a special dividend. All in all, it's a total dividend of 5.1 million compared to 1.2 million last year. On this note, I would like to call Morgan back to give you the outlook.
Thanks, Tinei. All right, yeah, so I think in terms of the numbers, you will see that the turnover in international is much higher than in limited, but because our production base is in international had a challenge because of El Nino, we ended up exporting quite a lot from Zim to the region. Now, obviously, the profitability when you are importing versus when you are producing locally is a lot lower. That's why you see the profitability in international lower than in Zim. They did sell a lot of imports from Zim. Overall, as a group, I think you can see what it has done to the numbers. Also, the numbers this year, happy with the numbers because we started right from day one accounting in US dollars, whereas in the previous year, it was a case of coming up with exchange rates to convert the numbers that we had reported, and there were a lot of distortions that did arise as a result. I would have expected a loud cheer in terms of Seedco Limited returning to dividend. We obviously are quite keen to see that dividend cover going up as quickly as possible, but we are also mindful of the liquidity issues in Zimbabwe, and we're trying to be careful to not overcommit ourselves in terms of the payout. As Tinei did mention, we're still owed quite a bit by the government. Yes, there have been payments post-year end, but not significant enough. And as we unwind those debtors, we would like to be seeing that dividend rate going up as quickly as possible. Just in terms of the outlook, so again, yeah, I mean, we are a food security counter, and we expect to remain very relevant in all the markets that we are in. We know that food security is important to all the African governments. This financial year, this coming financial year, we'll have very improved stock availability. Last year, we had about 43,000 metric tons. This year, we're expecting to get about between 53 and 55,000 metric tons that should be available for sale. You will see that the volumes that we sold in our regional businesses generally went down because those businesses ran out of stocks during the peak selling season. This coming year, we expect stocks to be a lot better. The activities that are happening in Tanzania and Ethiopia, we are expecting to upscale those. Those are profitable entities, and the demand is growing, and those are markets where we're growing market share not by taking market share from other companies, but by creating new market share through converting people who were using farm-saved seed to using improved seed varieties. We know that there are elections in Malawi and Tanzania very soon, and seed is always used as an important electioneering tool. So expect pent-up demand again in those markets. We're seeing some good growth in Angola, in DRC, and in the Lakes region. That's Uganda, Rwanda, Burundi, and that should add positively to the bottom line. We've also localized most of our borrowings to reduce FX risk, and that again should help the income statements. For those countries that still have shortages, we are again going to be exporting from Zim to address those challenges, and that should help the Zim numbers. And what we are doing in terms of hardening our sales through direct cash sales in our own shops, and also in most of the regional markets, we are gravitating away from giving credit and insisting on bank guarantees before we sign up people as distributors and so on. And we think this will help us in terms of reducing credit losses, but also bringing cash more quickly to our own tills. So yeah, I mean, going forwards, we think we should be able to keep growing the business. We should be able to keep growing the dividend. And let's hope next year when we stand in front of you, we'll have doubled the dividend that we've declared. Thank you very much. Questions? Yes, sir. I've got the Zim MD sitting here. Feli, do you want to take that? Yeah, but what you also see is that, so the margins on export are a lot lower because, I mean, you have to leave margin for the exporting countries to be able to make some money. So you find that where they are recording an average GP of around 57, 58% locally, on exports, the margins are a lot lower. I think you're making margins of around 20 and 25% for exports. So that does have an impact on the profits. While it does impact the volume significantly, the impact on the profits is limited because you have to leave margin for the businesses that are going to do the final sale to the customer. Yes, sir.
Thank you for the presentation. My question is just a follow-up on that. With regards to margins, what are you forecasting as a business, considering the bumper harvest that we're expecting as a country? Do you think there'll be an ease in terms of cost pressures coming from the cost of the seed itself? Will it be lower this year, and will that positively affect margins in the Zim business?
Well, so we are seeing cost pressures in our production model. So obviously, all growers now want to be paid everything in US dollars, and growers, like any businessman, they always want more money. The challenge for us as management is to try and balance our selling price versus what we are paying the growers. We obviously cannot, if there's an increase in the cost of production, we cannot absorb it ourselves. We have to at least pass on a portion of that. So we expect our margins to remain more or less where they were. Any increases, we have to share them with the market and defend the margins. Yes. I think in total we are owed about 40 million by quasi-government institutions, And I would say 20% of that is probably from prior year. Yes, sir. Yes. Okay, ladies first.
Just to follow up on the government debt, what has been the payment pattern like? Is there like a 1 month waiting period or a 2 month waiting period?
So in some instances you get some cash flow every month, and then they can go for 2 or 3 months before anything does come through. So it's not very predictable. We have been engaging them, but yeah, it's very it's difficult to predict. What we can say is we are receiving money, but for me to tell you what you are going to receive this month, it's very difficult.
But I think what normally tends to happen is just before they uplift orders for this year, that's when they make significant payments. So we're still hopeful that they will make a significant payment just before the start of the coming season.
Yeah.
What has been the impact of the export retention policy to the business, and what are the strategies that are being based, given that there is the further 5% added to the policy?
I wouldn't say there has been a big impact on the business per se. I think everyone has been complaining about that 30% retention, but I think it is what it is. When you are operating in Zimbabwe, it gives you a right to operate. You have to operate within the government regulations. Obviously, as an exporter, we would want to be getting 100% of that, but it is the environment that we operate in, and it's not an issue that's just affecting us, it's affecting everyone else in the market, and we just have to comply.
But maybe just to add that the stability in the ZiG has also helped that even that which is translated has not really lost value when you look at the rate official versus current. I think that stability has been welcomed by the sector.
Yeah. Yes, sir. You want to take that, Feli?
I would say there hasn't really been cannibalization of maize land by tobacco, because even when you look at the projection of this year, the national harvest is quite huge, which indicates that there's stability on maize, but maybe it's more maize versus other food crops like your soya bean. That's where we've seen some decline on the soya in favor of maize. But government policy generally in the pricing that they put on maize grain is actually supposed to be incentivizing farmers to produce maize.
Yeah, I think the key thing is most of the maize that's produced by the communal farmers is for own consumption, with a little bit going to the markets. So once you stop producing maize, what do you eat? It becomes a big challenge. You can't stop eating and start smoking, you know. Any further questions?
So still on that, if there's a record harvest, obviously this is a record in a long time. Are you seeing that translate into volumes? Is it your record year in terms of maize volumes?
Grain or seed?
Grain, whatever, there's a buffer harvest.
Yeah, so I mean, in terms of what we sold, we showed you that our sales actually went up by 92%, not just because of local, but also because of exports. But I think fairly, your local sales, out of that a figure of 19,000 or thereabouts that you had, we had almost between 8 and 9,000 as the local sales that were in this market. I wouldn't say that has been your record local in terms of local sales, because in previous years we've sold more maize seed. But yeah, certainly I think the harvest this year was helped by the rains that we had. You remember last year we had some serious challenges because of El Nino and so on. And a lot of the yield is not just about seed, it's also about availability of other inputs and so on, which then does help the overall national harvest. Yes, sir. Mm-hmm. Well, I think so. We have various stakeholders. The government itself is a stakeholder, which wants income tax, but we also have shareholders who want a return for their investment. And I think it's a balancing act. You cannot ignore one or favor one stakeholder at the expense of the other. It's the reality of business. You have to be paying your shareholders a return. I think, you know, the government is an investor in a number of companies, and they are also pushing for dividends. Yes, Thaddeus.
Just follow up on the government debt, on the payment. Are you getting paid cash or are they paying using TPs?
No, cash.
Is it to the team if you're getting TPs?
No, we're not getting TPs. Yeah. Amina, you look like you want to ask a question. Okay. Are there no further questions? If there are no further questions, I think there's some refreshments outside. This is March. We normally give you guys seed, but we can't be giving you seed in June. It will be eaten by weevils. We'll give you seed. We'll give you seed when we do the interims or when we do the AGM maybe. Otherwise, thank you all very much for coming, and please join us for a drink and we can take further questions. Thank you.